I'm Anthony Scaramucci, and welcome to SALT Talks. As many of you know, I'm the chairman of SALT, a global thought leadership and networking forum encompassing finance, technology, and politics, as well as the founder and managing partner of Skybridge Capital, a global alternative investment firm. I am channeling my John Darcy here, so bear with me. SALT Talks is a series of digital interviews with the world's foremost investors, creators, and thinkers. Just as we do at our global SALT events, we aim to both empower big, important ideas and provide our audience a window into the minds of subject matter experts. And by the way, we really have a tremendous one today. I am very excited to welcome Cathie Wood to SALT Talks. Cathie registered ARK Investment Management as an investment advisor with the Securities Exchange in January of 2014. With over 40 years of experience identifying and investing in innovation, Cathie founded ARK to focus solely on disruptive innovation while adding new dimensions to research through an open approach that cuts across sectors, market capitalization, and geographies. Cathie believes that ARK can identify large-scale investment opportunities in public markets resulting from technological innovations centered around DNA sequencing, robotics, artificial intelligence, energy storage, and blockchain technology. As CIO and portfolio manager, Cathie led the development of ARK's philosophy and investment approach, and is ultimately she's responsible for the investment decisions. Prior to ARK, Cathie spent 12 years at AllianceBernstein as CIO of Global Thematic Strategies, where she managed over $5 billion. Cathie and I both know that an overnight success takes about 25 years. Am I right? Cathie joined Alliance Capital from Tupelo Capital Management, a hedge fund she co-founded, which in 2000 managed approximately $800 million in global thematic strategies. Prior to her tenure at Tupelo, she worked for 18 years with Jennison Associates as chief economist, equity research analyst, portfolio manager, and director. She started her career in Los Angeles, California at the Capital Group as an assistant economist. And so we are super proud, frankly, Cathie, to have you on with us today. Hosting this SALT Talk is Lisa Diaz, my former boss, and she's now president and chief executive officer of Prince Street Capital. And for anybody that worked at Goldman Sachs in the early 90s, she was your former boss too. And that includes you, Lloyd Blankfein, who I know listens to every one of these SALT Talks. And Lisa Diaz is now, she's the chief executive of Prince Street Capital, a specialist emerging in the frontier of market hedge fund focused on uncovering the most innovative emerging markets for national champions within the e-commerce, healthcare, fintech, and infrastructure space. I probably read that terribly, Lisa, but let me tell you something. What I know about you is you are one of the great innovators and one of the great groundbreakers in our industry. So I'm super proud to have you lead this discussion with Cathie. And I'm going to put myself on mute, which is a rarity for me, Miss Wood. I have to tell you that right now. Go ahead, Lisa.
Thank you.
Anthony, thank you. That was a very kind introduction. So Cathie, to follow up on Anthony's comment, an overnight sensation. I know you back from the 1980s, and I know the path was not straight upward trajectory or a J curve. So can you talk to me or give us a sense of what do you think was the breakout phenomenon? What were the pieces of the equation that came together that made you a household name that everyone knows about? Especially, let's be honest, you're a woman. You're probably the most famous woman investor, I think, on the street right now. So what were the convergence of events that happened?
I love the word convergence because that's what we are really focused on, the convergence among innovation platforms that are growing exponentially. There are 5 platforms, 14 technologies. And I think there are a couple of things that happened. First of all, we were fulfilling an unmet need. What happened after the tech and telecom bust and then the 08-09 meltdown is you had really quantitative research take over and benchmark sensitivity increasing. if not outright passive investing. Now, at the same time, the seeds that were planted during the tech and telecom bubble, and before that, actually, really over the 20 years, starting in 1980, the seeds for the innovation platforms around which we have centered all of our research, they were planted back then. Back then, there was too much capital chasing too few opportunities too soon. Why? The technologies weren't ready. Oracle and Cisco are not taking us into the new age. So the technologies weren't ready, and the costs of them were way too high. Good example, DNA sequencing, 2003, only 18 years ago, it cost $2.7 billion and took 13 years of computing power to sequence the first whole human genome, just one person. Today, it's about $500-600 and takes an hour or so of computing power. Think about that. That's 18 years. But it took that long for the cost to drop low enough, which is the critical variable in order to scale the technology. So that, I think, the fact that we saw an unmet need, that the market had gone passive effectively, even benchmark sensitivity to me feels very passive. And at the same time, innovation in the private markets was being valued at multiples of what it was being valued in the public markets. And we knew investors did not own enough innovation in the public markets. And we also knew there wasn't enough research. And so we started an open research ecosystem. We give our research away. We believe we're the first sharing economy company in the asset management space when it comes to research. And in the sharing economy, if you don't give, you don't get. We are sharing our research because we want to become a part of the communities that are doing the research. And we get so much back from them. They will tell us when we're making mistakes in our models because we share our models. And they will tell us when we've made a mistaken assumption that we don't even understand we've made. That's really important because in the world of exponential growth, if you make an incorrect assumption early on and you carry it along too long, you'll make an exponential mistake potentially. So that's been really helpful. And I think the third thing is the gratitude that we're getting from individual investors who are reading our research and taking it seriously and investing accordingly. Because we run active equity ETFs, we have to disclose our holdings at the end of every day. We go one step further. We publish our trades every day. And now we've got YouTube sites out there which talk about our trading every day. Or they talk about the latest controversy that ARK Invest has attracted, shall we say, from the traditional financial world. And so I think we've gone a bit viral, in a way that I never expected. We've gone a bit viral. And I think one of the reasons is our research is not just about investing. Our research is educating individuals and businesses about how the world is going to change and how to get on the right side of change and stay there so that they can not only do that for themselves, but guide their children and their grandchildren. So I think this is much more than just investing. And I guess the technologies were right to enable us to do this. It couldn't have been done 20 years ago. So I think everything came together.
Well, it's an amazing phenomenon. So when you think about it, do you think innovation is an asset class? And if it's in fact an asset class, how big can it be? And how invested do you think the market is currently?
Well, we think that if you mean the market, institutions in particular, we think they are short innovation in a big way. We think individuals have a much higher weight in innovation and are more correctly positioned, actually. Yes. So innovation, is it an asset class? No. I think the before crypto, this is the new asset class, crypto, the crypto asset world. and before that, equities in the 1600s. So those are asset classes. This is a categorization, and interestingly, we can look at what happened with emerging markets. MSCI, what's its claim to fame? One of its biggest is creating the category of investing called emerging markets, because when I was at Capital Group, and Capital was a global investment firm at the time, way ahead of its time, I remember we were investing in Brazil and Malaysia. We were doing country by country, right? And MSCI basically said, well, wait a minute. Each of these countries has idiosyncratic risks. Why don't we construct this category to lower that risk and increase the return of investors' portfolios as they allocate to emerging markets, a new category. MSCI has just done that with innovation, and they did it with keywords from us. They approached us and asked, would we be willing to share the keywords we associate with innovations? So we considered that high praise. We were trying to attract the institutional world to innovation, but it was a no-go because there was no benchmark. Now, I just told you how much I hate benchmarks, but there was no benchmark. So against everyone's expectations, we agreed to do this with MSCI. And they have created some very thoughtful indices. They've taken our keywords and used artificial intelligence to scrape the world. And whatever they do, the convergences they use are different from ours. I've been surprised at how low the overlap is, actually. They have 400 to 500 stock portfolios. Ours are 40 to 50 stocks, so concentrated, rifle shot. They've got more of the scatter shot. And so I think they're doing a service to the world, and they're doing for innovation what they did for emerging markets, because the 5 major platforms, as Anthony mentioned, DNA sequencing, robotics, energy storage, artificial intelligence, blockchain technology, they do not all behave the same way. I can tell you our autonomous robotics and autonomous technology and robotics fund, we just renamed it. It behaves very differently from our genomics revolution. But the interesting thing is they are both, they're not sector funds. They might sound like it, but they're not. In fact, even our genomics revolution fund cuts across healthcare, of course, that's the largest category, but one of the most important applications of genomics is in agriculture, crops, livestock, aquaculture. That's probably in terms of percent impact going to be where the biggest impact is in the ag space. So what we've done at ARK is, this is to anticipate one of your questions, is we have turned our research department upside down relative to traditional asset management. Our analysts are specialists in technologies that are going to cut across sectors. Mm-hmm. They are not specialists in sectors or subsectors. All of our analysts are very comfortable with technology. Technology is permeating every sector. I think analysts focused on healthcare and industrials and utilities are all going to be surprised at how profoundly technology is going to impact their sectors. And they're not comfortable with technology. So we set it up where each of our analysts is very comfortable with technology.
So traditional research is siloed, right? Yeah. I mean, that's what we're sort of talking about. So you're looking to weave themes across various asset groups. So I suspect the Graham and Dodd investing team would have said, you're crazy. Mm-hmm. And they would have discounted very voraciously the likes of names that we were talking about: Tesla, Teladoc, Zoom, Spotify. And what do you say back to them? What are their arguments, and have they started to fold? And is there a pickup in some of that institutional investor base that's underinvested in innovation as defined by ARK Asset Management?
we are seeing more interest. It's evolved much slowly than I expected, given how low the correlation of returns are in our innovation strategies relative to traditional growth strategies, and inverse correlation relative to value, of course. And so I've been surprised because I thought institutional investors were looking for those low correlations. In fact, they're embracing Bitcoin faster than they're embracing our strategy, which is even more ironic when you think about it. So crazy, yes, and many commentators out there actually call me Crazy Cathie, and they still do. And they will continue to do so. And I love it. And the reason I love it is there's a lot of disbelief in what we're doing. The stocks we own, if you are using a valuation based on this year or next year, and that's your primary screen in terms of either introducing stocks to a portfolio or sizing them, you'd never, ever buy our portfolios or most of the stocks in our portfolios. And so most people don't understand that we have a 5-year time horizon. Exponential growth in the early days looks very much like linear growth, especially when you're working from a very low base. And so most of the industry is linear in its thinking. Linear growth, that is. We're focused only on exponential growth. If you give us 5 years, the difference between linear and exponential is shocking. Let me give you an example. Last year, there were 2.2 million electric vehicles sold around the world, including China, the largest market. We believe that number is going to 40 million in 5 years. Now, that's almost a 20-fold increase. Most people do not believe that's possible. And the primary reason they believe that is they've never seen it happen. When they thought it was happening, tech and telecom bubble, it ended in tears, which is exactly what they expect our portfolios to do. You have to go back to the early 1900s to see this kind of exponential growth. And take the auto sector. That's where we saw exponential growth caused by technologically enabled innovation. So no one is expecting 40 million. Haircut that by half. We are now seeing some people saying, it might get there, could get there, but nothing like 40. And in the early days, in 2014, the numbers that traditional forecasters were using for EVs in the early 20s were like 250,000. We just did 2.2 million. So I think if you give us a 5-year time horizon and the multiples we attach to companies at year 5 are actually more mature multiples, their valuations are going to come down dramatically, but their growth rates in terms of earnings are going to be exponential. And I think it's that concept of exponential. If you think about our world, if you think about dividend discount models, you talk about Graham and Dodd, what are you doing? Oh, okay, if you have this exceptional growth, you have it for 2 or 3 years, and then you decay immediately to GDP growth, which, by the way, we think is going to be very low, 2 to 3%, until some of these innovations get to a level where they start moving the GDP needle. So the multiples we use are really more mature multiples than we think we will actually see at that time, but we want to be conservative. And so people say with our Tesla is now at a little bit below $700. Our bear case for it in 5 years, meaning no autonomous, is $1,500. So it meets our minimum hurdle rate of return, which is 15% at a compound annual rate. And I know during this correction, we've been in a serious correction for innovation for the last 6 weeks to 2 months. I think we're down 30 some odd percent from peak to, we were down 30 some odd percent peak to trough. What happened because of that correction, if we add up all of our price targets and rates of returns and all that, weighted by position in the portfolio, at the peak, our price target suggested we would have a 15% compound annual rate of return. We're really not comfortable that that was our where we are. In other words, we had a streak of very good performance, outperformance. After the correction, now the compound annual rate of return that we see is 25%. So instead of delivering a double over 5 years, this is not a promise, by the way, our compliance department would want me to add that quickly. Instead of a double over 5 years, we think we have a triple. And our confidence in all of these platforms and technologies is only growing. And our confidence in Tesla's outlook is only growing.
So it's safe to say you think this is an excellent buying opportunity, particularly for those institutions who have been non-believers in the innovation story.
Yeah, we think they're very short innovation. And the problem with that is that disruptive innovation creates creative destruction. Mm-hmm. We think more than half of the S&P 500 is in harm's way of being thoroughly disrupted, disintermediated. And so if for no other reason, they need a hedge. It's called innovation.
I love it. So ARK Asset Management is offering innovation as a hedge.
Well, that's how we, we got the idea from a value investor who called us up. And believe me, we were so happy to get calls at that time, called us up. We had all the time in the world for him. And he said, look, I'd never buy one stock in your portfolio. I don't even know how you can buy them, but I know my biggest risk is a value trap, and meaning cheap for a reason, including potentially going out of business. So I'm going to hold my nose and I'm going to put a little bit of innovation in my portfolio. This was a value investor.
Wow. That's a super interesting idea. So just switching gears and at the risk of talking my own book. So do you think innovation is a US centric or a developed market phenomenon? Or do you think innovation has gone global and there are opportunities that are unappreciated in the rest of the world?
I'll talk your book. I think,
okay.
I think that their innovation is global. And in fact, there is a race on, and it's importantly featuring China and the US, China influencing the rest of Asia, of course. And I think it's great for innovation. I think it's going to happen. These platforms are going to happen faster than they otherwise would if this were just a US phenomenon. So I know you're much more involved in Asia, emerging markets, and we think they're ripe with opportunities as well.
Fantastic. Do you have any favorite names in the emerging markets world that you can share with us?
Well, in terms of, let's see, I know one stock we have in common, that's Ping An Healthcare.
Yes.
So, the reason China is growing so quickly, and this was true with digital wallets like WeChat Pay and Alipay, is it didn't have the infrastructure to begin with. In the US, we were saying, it was good enough, lots of inertia. We were very loyal to our banks. I've been with my bank for more than 20 years. So banks have paid up to acquire customers. When you've got a viral technology like WeChat is, and you incorporate a payments ecosystem in it, it goes viral pretty quickly. And it is so much better than what they have, that even those in their 70s and 80s, merchants in rural areas, want to use it. They want to avoid counterfeit cash, right? Mm-hmm. Ping An Health, same thing. This is a digital approach to healthcare in China, huge unmet need, again, reaching into the rural parts of the country. Ping An itself, I don't know what the number is now, but the last time I heard the number, Ping An, the insurance company, had a sales force of more than 1 million people. And that is the kind of scale you need to think about as you're trying. And so there are a lot of evangelists for Ping An healthcare out there as well. So we love that. We think China in all of our platforms is a great competitor. So if you look at DNA sequencing, BGI is a great competitor. If you look at robotics, it's probably going to commoditize in China, so we don't have any plays there. If you look at energy storage, well, of course, you've got Tesla in China, so that's good. You've got an ecosystem building around China. We know that NEO. We don't own it, but we think that government decree, they want a local champion. We don't know if it's going to be NEO or XPeng, which is patterning itself after Tesla, or if it will be Tesla itself. I doubt that. I doubt that because China wants a local winner. But we think they're all over that market. Artificial intelligence, if you look at the league tables in chip technology, surprising number of Chinese companies, SenseTime and others. And I think the reason for this is China's need for surveillance. The government wants surveillance over its population, even more so. So I think AI, information, data is, they've been doing this for a long time. And then finally, blockchain technology. We know that China is going to have its own digital currency, the digital yuan. And it's interesting to see how they're evolving that. It's programmable. So if they want to prevent transactions, they'll be able to do that. So it's really, really interesting how quickly China is embracing these technologies and running with them. I think on that score, they want the digital yuan to become the reserve currency of Asia. So lots going on.
Lots going on. So we would be remiss. So turning to other asset class, Bitcoin. So Bitcoin, do you think, or what's your sort of vision for Bitcoin? Is it going to become a reserve currency? Is it scarcity value like real estate? It started the purview of every college student, including my own, knew about Bitcoin before their parents did. So what's your kind of vision going out 5 years and 10 years for Bitcoin as an asset class and a value?
We don't have to go out 5 or 10 years. It's here. We believe, we wrote a white paper in 2016 called Bitcoin Ringing the Bell for a New Asset Class. And so, yes, we believe it's here. We believe that Bitcoin is the reserve currency of the crypto asset ecosystem. We also believe that there will be very few huge winners in the crypto space. We think the cryptocurrencies are going to be the huge winners. So this is really flipping the internet on its head in terms of how it evolved. And the internet evolved without a payments infrastructure. And the reason for that is nobody thought commerce would evolve on it. This was for intelligence and academia, and consumers in the United States weren't even allowed to use the internet legally until 1991, Telecommunications Act. So we believe that the Bitcoin is, and crypto world, the value accrual, where we will see most of the value accrue is to the cryptocurrencies themselves. This is not what happened in the internet. In the internet, the protocols, so Bitcoin's blockchain is one protocol, Ethereum another, the protocols basically just became standards, right? Technology standards upon which these very valuable applications were built, Facebook, Amazon, and so forth. The value accrued to the applications. This time, we think the value will accrue to the protocols themselves and the currencies as measured by their currencies. We believe that Bitcoin is already the reserve currency of the crypto asset ecosystem. And we can see that in that many crypto assets, most I would say, are priced in terms of Bitcoin. So that's the unit of account. The currencies are very important. We think there will be maybe 4 or 5 that are going to accrue the most value. Now, DeFi, watching it evolve, I mean, we're in the Wild West, decentralized finance. It's very exciting. So that's probably why Ether is going to be another one. We do have a fund right now only with 2 currencies in it. This is a private fund, and that's Bitcoin and Ether, but we're scouring the scene. Some of the custody arrangements associated with others like Decred aren't quite there yet. So, again, we're picking our spots carefully. And so, yes, we think it's an asset class. We think Bitcoin itself I was quoted in some paper, I never said this, but someone did some homework and added what I was saying up and said, ARK thinks this is a $10 trillion opportunity when it came to Bitcoin. And I said, I never said that, but I did actually say it with the building blocks. We think institutional institutional going to say 5 or 6% of institutional portfolios, again, very low correlation. And that's sort of where real estate and emerging markets went. That would add $500,000 to Bitcoin's price. So right there, that's nearly a 10-fold increase. If you look at playing the role of cash on the balance sheet, which is, we did not incorporate this into our institutional white paper because we didn't expect it, to be honest. But now we see Square and Tesla and MicroStrategy. They have diversified some. In the case of Square and Tesla, it's 5% and 8% respectively. MicroStrategy, it's 100% of their cash in Bitcoin. So if you were to expect 1%, if corporations did that, I think this is just a US calculation too, that would be a 40,000 increase in Bitcoin. If it's 10%, closer to where Tesla is, that would be a $400,000 increase in the price. So again, another 8-fold increase. So, and those are just 2 use cases. I mean, the biggest use case is an insurance policy for anyone in the world, to protect against confiscation of wealth. And part of that, it could be inflation with unhinged monetary policies. I think that's much more of a risk in emerging markets. And so I think we'll see a lot of insurance policies being taken out in the form of Bitcoin. I often reflect that the Saudi princes probably wished that they had allocated some of their wealth to Bitcoin because they certainly didn't expect their own cousin to confiscate it. But that happens all over the world in ways that we don't even understand. And so I think that insurance policy could be the biggest use case.
So it would be replacing gold. Plus, there's no carrying and holding cost.
Exactly.
Which is a huge win.
So
to pivoting north, very far north, you've recently launched a space ETF. Mm-hmm. So I'm a Star Wars fan from way back. Tell us more about space and the opportunity, and how are you going to invest in it?
Right. And it's a very exciting opportunity. The reason, again, I'll go back to the technologies are ready and the costs have come down low enough. SpaceX has been a game changer here. Reusable rockets. I think Elon was doing it so that he could get to Mars. But from our point of view as innovation investors, the declining costs by reusing a rocket, I think the Falcon 9 is up to 9 times, if I'm not mistaken. Mm-hmm. Think about the drop in costs that represents. The costs of satellite technology are coming down dramatically as well. The cost to launch a rocket coming down. Antenna, probably the biggest gating factor. Those costs haven't come down as much as we like, but they are coming down, and will come down faster the more these satellites are launched. So these are all volume-driven cost declines, right? And something I'd like to explain here is Wright's law. Wright's law is a relative of Moore's law. Moore's law is a function of time, Wright's law, a function of units. And Wright's law says, Theodore Wright, from the early days of airplane manufacturing, observed that for every cumulative doubling in the number of airplanes produced, costs declined at back then a 10% rate. The technologies that we're seeing today, that number, that for every cumulative doubling, what's the cost decline in DNA sequencing? It's 40%, right? Think about that. And we can even decipher between short read sequencing, that's 40%, long read sequencing is 25%. Industrial robots, collaborative robots, that's 28%. Artificial intelligence costs are dropping 37%. The cost to train in using artificial intelligence, those costs are dropping 37% per year. That's not even a cumulative doubling calculation. So it helps you understand why these technologies are going to take off so quickly. They're going to unleash waves of demand, the more and more costs decline. Space is the convergence of many of the 14 technologies involved in our 5 platforms. So certainly robots, energy storage, 3D printing, huge use case. Aerospace is the killer app for 3D printing. Artificial intelligence. In order to get those 2 rockets to be reusable and to land at the same time without blowing up, that was an artificial intelligence exercise. And if you have watched what happened, failed every time. And then there was a success. The machine had trained itself. Success. I think they've had only one failure recently. Yeah. So all of these technologies are coming together. Now, I think when people look at our portfolios, they're kind of disappointed actually, because they're not seeing space exploration or Mars or what have you. They're seeing more mundane companies to some extent, some very exciting ones in another sense. But we think the 2 biggest use cases near term and within the next 5 years are going to be mobile connectivity. So the 3 billion people who are effectively in the dark, meaning no broadband, they will get broadband. And so that's an important use case. It's worth $40 billion per year, we believe, in revenues. And 10 billion of those are going to be in the US, believe it or not, because 40 million people in the United States, more than 10% of our population, have no broadband. Think about it.
That's horrible.
The bigger use case or the bigger application we think within the next 5 years is going to be hypersonic flight. And so that means we'll be able to fly from Manhattan to Japan in 2 to 3 hours, not 12 to 14 hours. And we think that market is going to scale to $270 billion revenue opportunity per year over the next 5 to 10 years. That's a huge market. And as these costs continue to go down, the odds of getting to Mars go up. So yeah, we're pretty excited.
You and I both went to Australia. Wouldn't it be nice to get to Australia in 2 hours?
Oh my gosh.
We could have lunch. It would be great.
It would be great.
That would be great. So finally, this all sounds rosy and fantastic, but what keeps you up at night? Like, what do you worry about? What could derail the market, innovation? What causes you concern or worry?
Well, I will say, innovation is not the worry. In fact, the coronavirus unleashed waves of innovation because, again, innovation, the cost declines are dependent on volume growth. Innovation solves problems. The coronavirus presented us with a lot of problems. And so all of our platforms were turbocharged in terms of unit growth. So we think there's no going back. Sure, you have your stay-at-home stocks that were rewarded, but if you look at even them, take Zoom, it's been cut in half since last October, I think. So this exodus from stay-at-home has already happened for those of you who are playing it. Maybe there's a bit more to go. I have no idea. What keeps me up is our fiscal policies in the United States. Remember what I mentioned before, the competition in the innovation space. China is basically willing innovation into, like, they're doing everything they can, policymakers, to encourage innovation there. And I fear that our policymakers are going to discourage innovation in the US. So what this will mean, and I'm glad we run global portfolios, that more of the innovation, sources of innovation, are going to come from the rest of the world, probably Asia. We just hired an Asian innovation analyst for this reason, and we're going to hire another one because we think the US risks losing the plot. And personally, I think the best way to grow out, to get out of our deficits, is to grow out of them. Raising taxes is going to discourage activity and discourage growth. So I would implore, Anthony, I would implore anyone you have in Washington, I would just implore them to think about this. We're going to hurt our competitive positioning in the world.
Yes.
And innovation is going to accrue to the countries that encourage it. Raising taxes, raising the capital gains tax rate, raising the estate tax rate, tax rates of any kind, is going to discourage innovation. So that worries me. It truly does. I am not worried about inflation, not in this country. In fact, I think the opposite is the risk. We think we're in a deflationary world for two reasons. One's good, one's really bad. The good deflation is coming from innovation. Remember, I said costs coming down, units exploding. That's very good. The bad deflation is going to occur because companies paid too much attention to short-term oriented shareholders who, after the tech and telecom bust and 08-09, wanted their profits, and they wanted them now. They wanted them, on a regular schedule. They wanted a constant diet, right? Okay, so what did companies do to satisfy those investors? They leveraged up their balance sheets to buy back shares, one way to get earnings up, and pay dividends. What they did not do enough, and GE and IBM are poster children of this, they did not invest enough in innovation that is going to disintermediate and disrupt that already is. And so what will happen to those companies is that in order to service their debt, as they are going out of business anyway, they will have to cut prices, and they'll probably lose money, bring cash in, reported earnings will go down. That's bad deflation. So I'm really not worried about inflation. And in fact, in the world we see, deflation has, it has the opposite effect of inflation. In the 70s, which is when I started in the business, so I remember these debates, what had happened that economists didn't expect, including Milton Friedman, the monetarist himself, was while money supply seemed to be growing at a consistent rate, the velocity of money was picking up. And the velocity of money was picking up, which means the rate at which the money turns over per year. It was picking up because people, investors and individuals were buying, they were buying tangible assets, right? And they were trying to get out of their fiat currency, which was depreciating, as fast as possible. So they'd buy now before prices and interest rates go up, or buy tangible assets to protect against inflation. The opposite will happen with deflationary forces, the two deflationary forces I mentioned. If you think prices are going down, then at the margin, you'll wait to buy until they do. Now, interest rates are already down low enough, but pricing going down is going to stall some purchases over time. We think the early adopters are going to be there, and that these cost declines are going to happen because of them. but not everyone's an early adopter. So it's going to be a really interesting environment. It's going to be the flip side, I think, of the 70s.
Mm-hmm. Interesting. So when you look back, so we'll go five years ahead. What will have been the underappreciated innovation that you think that's going to surprise on the upside? Not to you, but the general marketplace. What is the most unappreciated of your innovation themes?
The cures for disease that we're going to see.
Yes.
And the prevention of deaths. By our calculations research, if you take the 35 most common cancers in the world today, and you create tests that are like blood tests, liquid biopsies, they're called, you'll be able to identify cancer in stage 1. Now, we do think that the convergence between and among DNA sequencing, artificial intelligence, and gene editing and other gene therapies and technologies, the combination of those, the convergence, we think is going to save 66,000 patients who develop cancer from death, because they'll catch it in stage 1. Yeah. We think artificial intelligence is going to teach us that there's a setup that the body goes through before cancer triggers. And we'll probably find out about those precursors ahead of time and head them off at the pass. So that's one thing. I think, and that's for sort of the general population, and as we've been growing up, I think all of us have watched friends and family members die of cancer. Yes. And it is the scourge of our age. And so I think we will find a cure for cancer, or at the minimum, we'll have the ability to identify cancer in stage 1. The other, for the investors' surprise, and I think investors will be surprised at how provocative that's going to be in terms of the values created out there. But in terms of the average investor out there, I think that there are companies in the biotech space, especially pharma biotech, not all of them, careful, there's a minefield out there, who are embracing these technologies. And because they are, we think that clinical trials, the time to the time a clinical trial takes is going to drop by at least 25%, and the failure rates are going to drop by 25%. And so we're going back into the golden age of healthcare. In the 80s, we saw the golden age, monoclonal antibodies, Genentech, the new biotech companies. This wave, and we got returns on R&D investing up to 20 to 30% in that golden age. Today, those returns on average are 7% because of generics and a paucity of innovation, kind of buying back shares and satisfying short-term oriented shareholders. That has changed, and it's changed in the last 4 years, so that we think there are going to be some big surprises coming out of the companies that have embraced these technologies. And we think the returns will go even higher than they were in the 80s. It's to say clinical trials will take 25% less time and result in 25% fewer failures. Those are huge numbers in that world. Huge, huge, huge. So it's going to be pretty exciting.
Yeah, I mean, following up on China, you probably know these statistics, but in the US, 70% of cancer patients have a 5-year survival rate. In China, it's 40%. Yeah. So there's about 1.5 million people who are dying every year, who with preventive medicine, more being able to catch it early, would be able to survive. And that's been one of the focus of the Chinese, as you mentioned, centralized government, to improve health and wellness in China. And this ability to diagnose cancer early is a game changer, Because as you know, if you diagnose cancer at stage 1 versus stage 4, I mean, there's 2 dramatic impacts. The survival rate goes off, is exponentially positive, but also the cost of treating the patient is much lower. So it's a virtuous cycle.
Yes.
On that note, I think our friend Anthony wanted to add in some other questions. And, Anthony always has to have the last word, right?
Well, not in this case. There's no question about that. It would be foolish of me to have the last word with the two of you. But no, I don't have many questions, Cathie. I just have one big question. And I hear you loud and clear on taxation, by the way, but they're not going to listen to me or you. I mean, they've decided long ago that they want to detach themselves from the business community and from reality. And so whether it's Mitch McConnell saying, stay out of politics if you're an executive, I mean, who is he to say that? Yes. Or you're the Biden administration wanting to make the tax system less competitive with the world, but yet continue to spend money that we don't have. I mean, look, that's the world that we live in. But I guess what I wanted to ask you is about the future, because I know that you see from your writings a world of abundance. You see technological innovation and technological transformation. And one of the worries that I have is the distribution of it. I'm worried that it's leaning too close to the haves versus the have-nots in society. And one of the fears that I have is that if we don't use free market forces to make it fairer, then you'll have some type of imposition by the government. As you and I both know, that will make things way worse. Because it'll be disruptive to market forces. So obviously we're both great advocates for capitalism and for the free market. What could you say to people about the abundance ahead and how we can spread it out to make it more fair, but to make it market-based?
Well, innovation is about abundance, right? And getting costs down. So I think we learned from the smartphone, right? How we were able to change the world, bringing more access to more people, access to innovation, information alone, and financial services now. So I think innovation in terms of getting costs down is the solution to that problem. It is, because the lower the cost, I'll give you an example. We believe that autonomous taxi networks are going to evolve much sooner than most people think. And according to our analysis, the cost of transportation per mile for a person will drop all in. This is all in. So in our personal car, it costs roughly 70 cents per mile. And by the way, if you inflation adjust that, it has cost 70 cents per mile since the first cars rolled off the assembly line, right? So 70 cents. We are going to have a discontinuous shift down in that cost to 25 cents or less. Think about all the people who are taking buses, and they're going to be able to hop into a robo-taxi. So I think that's a really good example. Think about that, the increase in purchasing power purchasing power associated with transportation, which is a huge problem, a huge source of friction in the lower income world. So innovation's always about cutting costs and enabling more access to better, cheaper, faster, more productive, more creative. So I think that's a solution to the problem, not a part of the problem. Now, in terms of what you may be saying, historically, the big innovations that have generated outsized returns, those have taken place in the private market. We founded ARK to democratize access to these ideas. And I'm so gratified. Many people I know think there are a lot of problems with SPACs, and there are some problems, of course. But SPACs are enabling us to do that, enabling us to be able to share these opportunities with individual investors. And, the gratitude we get, as I mentioned before, is mind-blowing, the gratitude, you've changed my life, or what have you, or I've now changed my career. So it's either investing or education. So we're trying to become a part of the movement to include access to opportunities for everyone. So I understand what you're saying. We're trying to be a solution to that problem. And I think our technologies are as well.
Well, listen, I think it's very well said. I don't have anything much more to add. I don't know if Lisa does, but Cathie, I really appreciate you joining us on SALT Talks. I hope we can get you to our live events someday when we're all vaccinated. We have an event planned in New York City at the Javits Center in September, which I think will be a fun, well-attended event. You may know this. I've recently signed on as a contributor to CNBC. So,
I have noticed that. Yes, indeed.
Yeah. So you're stuck with me, Cathie. You're not going to be able to get rid of me. I'm sort of like toe fungus. Once I'm in your life, ask Lisa Diaz. Once I'm in your life, it's like impossible for me to get out of it. So, but in all seriousness, I want to congratulate you on your success and your spirit of enterprise, your innovation, the entrepreneurship, the breakthroughs that you've made. Frankly, I'm proud to know you. So I just want to say thank you for joining us.
Thank you so much. It's been my great pleasure. Thank you again.
Okay, so this concludes our SALT Talks. I am not John Darcy, so I'm not going to use the usual exiting verbiage that John Darcy uses. But I want to thank Lisa Diaz as our guest interviewer and Cathie Wood for a sensational SALT Talk presentation. Please log on to salt.org/talks to catch this and many of the other talks in our SALT Talk series. Guys, thank you very much again.
Thanks again.